regulators. I've heard from many lenders that they are willing to offer more relief options. However, if the lender does modify a student loan, then they have to account properly for modifications on their books under the GAAP accounting standards. And a high number of modifications could signal to the prudential banking regulators that the lender's loan portfolio is not safe or sound. Thus, we have a situation in which the CFPB is advocating for certain relief options that may not be possible under current guidance and prudential banking regulations. First of all, is that correct? And how can lenders offer loan modifications without running afoul of the safety and soundness and accounting standards that they now must qualify under or must pursue? Mr. Lyons?
Senator, we encourage banks to work with customers when they have financial hardships. That would be reflective in the portfolio regardless of whether they did that or not. So whether it was a TDR or not, you would probably have a past due loan and a delinquent loan. So it would still be, the risk would still be identified in the portfolio. So we encourage banks to work with customers before they get to the point where it's severely delinquent. Banks do have the flexibility of offering a number of different programs, but as we did say, they are responsible for accurately reporting those transactions on their balance sheet. They have a fiduciary responsibility to their depositors, investors, and shareholders that they accurately report the risk profile of those portfolios.
Thank you. Mr. Vermillier?
So very similar. We expect our banks to work with borrowers in a way that benefits both the bank and the borrower. A restructured loan that is performing is far better for everyone than a severely delinquent loan or a charge-off. We also expect banks to follow basic principles of sound risk management. Typically, for a bank that has a large portfolio of restructured loans, we would expect them to segregate these loans from others on their balance sheet and then monitor the risk characteristics of this portfolio, understand the probability of default, understand the loss-giving default, and then hold appropriate reserves and capital. If a bank could demonstrate with their data that these loans performed in the same way as past credits, then that would be a perfectly appropriate outcome. But we always expect banks to follow accounting guidelines as well.
Thank you. Ms. Eberly?
I would agree with everything my fellow panelists have said, that when you have a troubled debt restructuring, you by definition have a troubled debt to begin with. So the actual accounting designation of a TDR really doesn't impact the examiner's view of whether or not the debt was troubled to begin with. It does impact the examiner's view about the bank's ability to work with that borrower and turn a problem situation into a better situation. By definition, a troubled debt restructuring indicates that the bank is working with the borrower, taking a bad situation and trying to find a way out. It is important that our examiners do take a look on the back end, as Mr. Vermillion noted, of an institution's results with their troubled debt restructurings, with their modifications, to make sure that modification programs are reasonable and are ending up in a result that is good for both the consumer and the bank.
Thank you.